Last week's close snapped a 2-week losing streak, but the headline indices are completely masking some severe structural fractures under the hood.
Oh, absolutely.
I mean, the S&P 500 closed Friday at 7,489.72. That's logging a 1.05% gain for the week.
Right.
And the NASDAQ 100 closed at 28,148.98, which is up 1.6%. But, and this is the crazy part, zooming out to the monthly time frame, we just logged the first negative July since 2014.
Yeah, that is a massive historical anomaly.
The S&P closed the month down 0.13%. So it's a completely flat headline number on the monthly, but on the intraday tape, the price action has been just, well, nothing short of violent.
It really has. I mean, it is Sunday morning, and we are resetting the deck for tomorrow morning's opening bell. And that flat monthly headline you just cited, that down 13 basis points for July, it's the ultimate illusion of stability, right?
Yeah, completely.
Because if you look at the historical seasonality, July is statistically just a powerhouse month for equities.
Usually, yeah.
Right. It's usually driven by Q2 earnings digestion and forward guidance. So the fact that we printed a negative July for the first time in 12 years tells us that the institutional capital flows are actively recalibrating.
They're rotating hard.
Exactly. The single biggest macro theme driving the market right now is the death of broad beta. I mean, institutional patience for generic tech exposure has just evaporated.
Boof. Gone.
Yeah, and we are seeing a ruthless transition into extreme selectivity.
Okay, let's unpack this, because for this deep dive, we have our hands on the weekend prep script that's floating across institutional desks literally right now.
Yeah. This is the real deal.
It's an internal diagnostic called Bulls, Bears, and the Bell. And our mission today is to strip out all the noise and look at exactly how the smart money is positioning for tomorrow.
Because tomorrow is going to be critical.
Right. Because the dispersion we saw inside that NASDAQ 100 rally on Friday was historic. I mean, Amazon ripped over 15% on the session.
Huge move.
And Apple dumped 7.2%. We have a $1 trillion allocation gap opening up inside the mega caps in a single trading session.
Yeah, and what's fascinating here is that 15% move in Amazon, it represents hundreds of billions of dollars in market capitalization shifting in a single operating window.
It's just staggering to think about.
It is. And the Bulls, Bears, and the Bell script zeroes in on this immediately. It categorizes this as the AI Monetization Split.
AI Monetization Split.
Right, because the mandate from asset managers, it's no longer just to blindly acquire AI beta, it is to demand actual operating leverage from all these AI capital expenditures.
Show me the money, basically.
Exactly. Amazon demonstrated aggressive cloud utilization and tangible AI monetization, so they captured the premium, they got rewarded.
But Apple didn't.
Right. Apple delivered weak revenue guidance, which signaled a delay in their hardware refresh cycles, and the market just amputated their multiple.
I mean, think about the last 36 months of capital deployment. It's like the construction of a transcontinental railroad.
Oh, that's a good way to look at it.
Right. For the last 3 years, the entire market aggressively bid up the track laying companies.
Yeah.
Everyone bought the foundries producing the steel, the engineers designing the routing, the heavy machinery operators.
NVIDIA, AMD, all of them.
Exactly. We bought the infrastructure and the hardware without really questioning the final yield. But now the tracks are laid. The infrastructure is operational.
And the institutional money is standing at the terminal.
Right. They're looking down the tracks, demanding to see the actual freight trains moving cargo. If a company cannot prove that freight is moving, if they can't show the software monetization flowing over those hardware tracks, the market is pulling their funding immediately.
And the script specifically isolates the hyperscalers in this dynamic.
Right, the cloud giants.
Yeah, your AWS, your Microsoft Azure. These are the entities possessing the sheer computational density required to train and run these large language models at an enterprise scale.
Which isn't cheap.
No, it's massively expensive. So when a hyperscaler proves they are successfully renting out that computational density at a high margin, the capital allocators flood the order book.
Hence the Amazon rally.
Exactly. When you see a 15% gap up in a mature mega cap like Amazon, that is not retail momentum.
No, retail doesn't move a $2 trillion stock 15%.
Right. That is algorithmic, programmatic reallocation by pension funds and sovereign wealth. They are dumping underperforming hardware exposure and rotating into proven software and cloud monetization.
Which brings us to the underlying tape and the structural trend lines we have to trade against tomorrow morning.
Yeah, the technicals are really fascinating here.
Because if one of the heaviest weighted constituents in the S&P 500, like Apple, takes a 7.2% haircut, the beta sensitivity of the broader index should theoretically drag the entire tape down.
It absolutely should.
But it didn't. The S&P absorbed the distribution.
Yeah, it just swallowed it whole.
The script notes that the S&P 500 flushed to a weekly low of 7,313.92 midweek. But aggressive bidding stepped in to defend the primary weekly uptrend.
They defended it perfectly.
And they outlined the key pivot for this week incredibly clearly. It's 7,300 to 7,314. The document states, and I'm quoting here, losing 7,300 opens a trapdoor to 7,100.
And that 7,300 level, that is the structural foundation for the entire third quarter.
Yeah.
If we lose 7,300, the gamma exposure flips negative, the put walls get triggered, and you see systematic selling programs just start to execute blindly.
It just becomes a cascade.
Right. That 200-point trapdoor down to 7,100 is an absolute air pocket. There is no historical volume node in that range to act as a buffer.
It's just free fall.
Exactly. Now, the NASDAQ 100 defended its own critical trend line at a capitulation low of 27,176. And the script warns that if the NDX breaches 27,175, the market character aggressively shifts to a downside regime.
Meaning what, practically, for a trader?
Meaning every single bounce becomes a liquidity exit for trap longs. People just use any green on the screen to get out at break even.
Here's where it gets really interesting, though. Look at the volume profile on that defense. The script flags over 18 billion shares traded on the peak days last week.
Massive, massive institutional participation.
Massive. Yet the volume was highly concentrated in those mega cap earnings reports and the Federal Reserve rate decision.
Yeah.
The S&P equal weight index completely lagged the cap-weighted index.
Yeah, it was left in the dust.
We have 18 billion shares of volume, largely ignoring the median stock in the S&P 500. How does that even happen?
Well, the equal weight divergence is the canary in the coal mine for breath decay.
Right.
When the cap-weighted index defends structural support, but the equal weight index bleeds, it means capital allocators are hiding in liquidity havens.
They're just parking money.
Exactly. They are stripping risk from the periphery of their portfolios and parking it in the top 5 names simply because those names offer enough daily liquidity to exit if the macro backdrop suddenly deteriorates.
Which makes sense if you're managing $100 billion.
Right, you can't just sell a mid-cap industrial stock without crashing the price. You have to be in Microsoft or Amazon.
And that macro deterioration risk is entirely centered on the long end of the curve right now. I mean, the equity indices held their trend lines, but the bulls, bears, and the bell script is hyper-focused on the U.S. 10-year yield breaking out to the upside.
This is the real story.
The U.S. 10-year surged 15 basis points last week to close at 4.75%.
Wow.
That is the highest weekly close since January 2025. So if the S&P is holding 7,300 so well, why is the script treating this 4.75% yield as a terminal threat to the equity tape?
Because of the valuation cap.
The valuation cap.
Right. A 4.75% 10-year yield fundamentally rewrites the cost of capital, and it alters the equity risk premium for every single asset manager on the street.
How so?
Well, the surge in the long end is being driven by persistent geopolitical risk premiums and, elevated energy input costs.
Yeah, oil has been sticky.
Exactly. So when the risk-free rate touches 4.75%, the hurdle rate for deploying capital into risk assets into stocks becomes extremely restrictive.
Because if a sovereign wealth fund or, a massive pension allocator can lock in 4.75% guaranteed yield with zero duration risk, assuming they hold to maturity, why wouldn't they?
Exactly. The multiples they are willing to pay for forward tech earnings compress violently.
It's just basic math at that point.
It is exactly the mechanics at play, and the script maps out the precise yield pivots controlling the equity algorithms right now.
Yeah, I saw this, the 4.80 level.
Yes. A sustained move above 4.80% on the 10-year triggers what they label cross-asset volatility.
Which sounds terrifying.
It is. At 4.80%, the algorithms that manage risk parity funds are forced to aggressively deleverage.
Because the bonds are dropping too fast.
Right. They have to sell equities to reduce beta exposure because the bond volatility is blowing out their risk models.
So the bonds falling forces them to sell stocks, even if the stocks are doing fine.
Precisely. Conversely, the script notes that if the 10-year yield rejects this breakout and drops below 4.60%, the valuation pressure on growth multiples is released and you get an immediate mechanical bid in the NASDAQ.
So we have the equity indices balancing on the 7,300 pivot, while the 10-year yield is threatening this 4.80% volatility trigger.
It's a total standoff.
That perfectly sets the stage for the macro calendar this week, because the data drops starting tomorrow morning are the exact catalysts that will break this stalemate.
Yeah, this week is heavy.
The script outlines the red folder calendar for the first week of August, and it is a gauntlet.
It really is.
Tomorrow morning, August 3rd, we have the ISM Manufacturing PMI. The script dictates a hyper-focus on the new orders and prices paid subcomponents.
Because the manufacturing sector is, well, it's a forward-looking indicator for cyclical momentum.
Right.
If the new orders subindex contracts while prices paid expands, you have the textbook definition of stagflationary pressure in the industrial base.
Which is the worst-case scenario.
It is. Input costs are rising due to energy and supply chain friction, but forward demand is decaying. That absolutely crushes industrial operating margins.
So tomorrow morning at 10:00 a.m. Eastern, the algorithms are going to be scraping that specific subcomponent data.
Oh, instantly.
Then Wednesday, August 5th, the complexity increases. ISM Services PMI drops alongside the ADP employment numbers.
Yeah.
And the script is explicit here. Services drive 80% of the U.S. GDP.
Yeah.
If we see sticky inflation in the services sector, insurance, healthcare, housing, it freezes the Federal Reserve's timeline for rate cuts.
Absolutely, because services inflation is largely insulated from supply chain normalization.
What do you mean?
Well, you can't fix a structural labor shortage in the healthcare sector by unsnarling a shipping port in Los Angeles.
Right. It's a completely different dynamic.
Exactly. If the ISM services prices paid component comes in hot on Wednesday, the bond market will immediately price out any probability of an autumn rate cut.
And that 10-year yield goes flying.
Yes, that 10-year yield is going to rip right through that 4.80% threshold we just discussed.
Which brings us to the main event, Friday, August 7th.
The big one.
The script designates this as the #1 risk event of the entire quarter, the July U.S. non-farm payrolls report.
NFP day.
Yep. The consensus expectation is 91,000 jobs added, with the unemployment rate ticking to 4.3%.
Yeah.
The document lays out these binary risk trades based entirely on this print.
Which is fascinating how binary it is.
It is. Scenario A is the hot data scenario. If NFP heavily beats that 91,000 estimate and the ISM prices paid components from earlier in the week were elevated, the script projects a spike in yields, a massive rally in the U.S. dollar, and a violent downward repricing in equities.
If we connect this to the bigger picture, the Fed funds rate is currently sitting in restrictive territory at 3.50% to 3.75%.
Right, they're keeping it tight.
They are actively trying to cool aggregate demand to kill the last mile of inflation.
Which is always the hardest part.
Exactly. So if we print 180,000 or 200,000 jobs on Friday, it tells the market that the labor market is re-accelerating despite the restrictive policy rate.
Which means the Fed's strategy isn't working as well as they thought.
It's completely boxed in. They cannot cut.
Could they hike?
They might even have to resume hiking. In scenario A, cash becomes the primary defensive asset, and duration risk in the bond market becomes completely toxic.
Okay, but what about scenario B? That's the the Goldilocks print.
The one everyone is hoping for.
Right. So NFP comes in at 91,000 or slightly softer, accompanied by declining ISM prices paid earlier in the week.
Right.
If scenario B hits, the 10-year yield flushes below 4.60%, the dollar softens, and we see a broad market rally characterized by capital rotating out of the mega-cap tech havens and into cyclicals and small caps.
Because that 91,000 number, it is the needle the market is trying to thread.
It's a very fine needle.
It is. It indicates that the economy is cooling enough to extinguish wage inflation and allow the Fed to confidently initiate a rate cut cycle.
But it isn't cooling so rapidly that we enter a severe earnings recession.
Exactly. It is the perfect glide path for risk assets.
Now, translating these macroeconomic scenarios into actual, actionable beta exposure. The script identifies exactly where the capital will flow based on the data.
Yeah, the sector warfare breakdown.
Right. In sector warfare, the most vulnerable allocations to a hot scenario, a print, are real estate via the XLRE and utilities via the XLU. The document specifically labels them capital-intensive bond proxies.
And that label is crucial. The beta sensitivity of REITs and utilities to the long end of the curve is immediate and severe.
Because they have to borrow so much money.
Exactly. These sectors rely on heavy, constant debt issuance to fund massive infrastructure and property portfolios.
Right. They aren't just sitting on cash like Apple.
Exactly. So when the 10-year yield spikes toward 4.80%, their weighted average cost of capital, their WACC, it just blows out.
Which crushes their profitability.
Right. And simultaneously, their dividend yields become completely uncompetitive compared to the risk-free rate.
I mean, that just makes sense.
Yes.
If you can get a risk-free 4.75% from a treasury bond, why take the risk on a utility stock paying a similar dividend?
You wouldn't. It causes massive institutional outflows. If scenario A hits on Friday, XLRE and XLU will be the primary sources of liquidity extraction.
On the flip side, the sectors most exposed to growth dynamics are industrials, the XLI, and tech, the XLK.
Yeah, these are tricky right now.
The script notes industrials require the ISM New Orders sub-index to expand tomorrow morning to justify their current forward earnings estimates.
Right.
But tech faces a real dual mandate. They have duration risk if real yields rise, which crushes their terminal valuations, but they also have cyclical risk if the economy slows too much in enterprise software spend contracts.
Tech is completely cornered by the data this week.
They really are.
I mean, if the data is too hot, the discount rate applied to their future cash flows drives their PE multiples into the ground.
Because future money is worth less when rates are high.
Exactly. But if the data is too cold and we see a severe labor market contraction, well, enterprise CIOs will slash their software and cloud budgets to protect their own baggage sheets.
Which hits tech's forward revenue guidance directly.
Exactly. They desperately need the scenario B Goldilocks print to maintain current valuations.
And because of this extreme binary setup, the script issues a really strict operational mandate to its trading desks.
Yeah, this part was fascinating.
It says, stay disciplined, do not front-run the Friday NFP print, maintain neutral positioning until the ISM prices paid data provides clear directional clarity on Monday morning.
And you have to understand the psychology there. The risk-adjusted return of trying to predict a binary NFP print is negative over the long run.
It's basically gambling.
It is. Institutional desks are not in the business of flipping coins with gross exposure.
No, they get fired.
Right. If they are caught offside on a hot print with maximum leverage, the drawdown is unrecoverable for the quarter.
So they just wait.
The mandate is to wait for the data to print, allow the initial algorithmic volatility to clear, and then execute alongside the confirmed macro trend.
Right.
You sacrifice the first 50 points of the S&P move to secure the structural certainty of the next 200 points.
Which brings us to the climax of the weekend prep, and honestly, the most critical variable for tomorrow's open: institutional positioning and the pain trade.
This is where the rubber meets the road.
We have the technical levels, we have the macro catalysts, and we have the sector betas. Now we look at the actual order book.
And the sentiment data is deeply, deeply polarized.
Oh, it's wild. The AAII survey indicates retail investors are aggressively defensive. 42.1% are bearish.
Huge number.
And only 31.0% are bullish. And the script flags that this bearish sentiment has tracked above the historical 31% baseline for 5 consecutive months.
You have retail completely sidelined. They are sitting in money market funds, anticipating a structural breakdown that just hasn't materialized.
But it's not just retail.
No, it's not.
The CFTC positioning data for leveraged funds, the fast money hedge funds and CTAs, shows they are aggressively defensive as well.
Yeah, they are massively short.
They are currently net short approximately 309,000 S&P 500 futures contracts, and they are actively stacking new short exposure on
the NASDAQ, yeah. It's aggressive.
Very. They are positioned for scenario A. They are betting the 10-year yield breaks 4.80% and the S&P loses 7,300.
And a net short position of 309,000 contracts is a colossal concentration of negative delta.
It's an expensive position to hold, too.
Very. These funds are paying heavy borrow fees and fighting the primary structural uptrend in anticipation of a macro exogenous shock.
So what does this all mean? Because standing on the other side of the trade, absorbing all that short selling, are the asset managers.
The real money.
Right. The sovereign wealth funds, the mutual funds, the entities managing trillions in long-only capital. They're holding a massive net long position of approximately 924,000 S&P futures contracts.
This is the ultimate standoff.
It really is.
You have the leveraged speculative money actively trying to force the market lower, while the unleveraged, benchmark-constrained institutional money is just absorbing the supply, refusing to liquidate.
Just eating it up.
Yeah. And the script dispels a major technical fallacy here.
The overbought narrative.
Right. A lot of the financial media right now is claiming the market is overextended or overbought. The bulls, bears, and the bell script rejects that entirely.
Because of the RSI.
Yes. They note the daily RSI is dead neutral. The S&P index is currently consolidating in the 7,425 to 7,440 range, which is well below the 7,620 structural peak.
The document states explicitly, quote, "You cannot have a true structural top when hedge funds are net short and retail traders are over 40% bearish."
And they're right. Structural tops require euphoria.
Right. Blood in the streets is a bottom, euphoria is a top.
Exactly. They require margin debt to be exhausted on the long side. Everyone has to be all in.
Which they aren't right now.
Not at all. When retail is sitting in cash and hedge funds are leveraged short, the market is completely devoid of the late-stage buying exhaustion that characterizes a cyclical peak.
The buying power is basically just sitting in reserve.
Right, while the selling power is highly leveraged and deeply vulnerable.
Which triggers the pain trade.
This raises an important question, right? What happens if they are wrong?
The script concludes that the primary pain trade for the coming week is violently higher.
Yes.
If we get the Goldilocks data, if ISM prices paid cools tomorrow and NFP hits 91,000 on Friday, the 10-year yield drops. The S&P will immediately test the overhead resistance band of 7,460 to 7,500.
And if the S&P clears 7,500 on a confirmed macro catalyst, the mechanics of a short squeeze just take over the tape.
Right. Explain that. How does that actually work at the prime broker level?
Well, those hedge funds holding 309,000 short contracts will immediately breach their risk parameters.
Because the market is going up against them.
Right. As the index pushes higher, their prime brokers will issue margin calls.
The dreaded margin call.
Exactly. And to cover a short position, you are forced to buy the underlying asset at market price.
And because the asset managers holding 924,000 longs have absolutely no incentive to sell into a macro-confirmed rally, the order book above 7,500 just becomes a liquidity vacuum.
There's no one there to sell to them.
The hedge funds will be forced to aggressively sweep the ask just to cover their exposure, creating this self-feeding gamma loop that drives the index higher.
It's explosive.
The script actually models this squeeze, targeting the 7,600-plus resistance band.
It is the mechanical extraction of liquidity from trap shorts. It has nothing to do with fundamentals at that point. It's just pure forced buying.
Right.
And the script highlights a secondary pain trade as well over in the commodities market.
Oh, gold positioning.
Yeah, managed money is heavily crowded on the long side in gold, holding approximately 124,800 net long contracts.
Which is huge.
It is. If the exact opposite happens, if we get a hot NFP print and real yield spike holding a non-yielding asset like gold becomes instantly punitive.
Because you could just hold the 4.75% treasury instead.
Right. That massive long position will rush for the exit simultaneously, triggering a cascading liquidation in precious metals.
It's just a coiled spring in both directions.
Yeah, exactly.
The bulls, bears, and the bell script provides the exact architectural blueprint for the week. Let's synthesize the game plan for tomorrow morning. First, we are trading the AI Monetization Reality Check.
Right.
The market will mercilessly punish hardware and broad beta exposure while heavily rewarding proven hyperscaler operating leverage. Second, the 10-year Treasury yield is the ultimate governor of equity valuations right now.
It controls everything.
4.80% is the volatility trigger. 4.60% is the relief valve.
And third, the structural positioning is a complete powder keg.
Yeah.
If the macro data prints cool this week, those 309,000 short contracts held by leveraged funds will act as pure upside fuel, initiating a forced buying cascade above 7,500.
The final directive in the script is honestly the most critical to remember as the bell rings tomorrow. I'll quote it directly. Do not mistake retail hesitation for an institutional top.
That's a great line.
It makes you wonder, in a world where we have endless access to financial data, is the most profitable institutional strategy simply figuring out what the crowd is terrified of and betting the exact opposite?
It certainly seems that way. When the crowd is terrified and the fast money is heavily short, the path of maximum institutional profitability is almost always a violent, relentless grind higher to force the unwinds.
Keep your eyes on the ISM prices paid subindex tomorrow at 10:00 a.m. Eastern. That is the first domino. We'll be watching the tape.
Good luck out there tomorrow.